Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, July 14th, 2020. What we're going to do is take a look at the equity markets. Just a quick update, kind of get out there, tell you what's happening, what's recently happened, and more importantly, what to look for going forward to see what this what today and yesterday is or isn't so far. If that makes any sense. I think it will in a second here. All right, so I'll start out with the futures. Just nice, clean little bear flag action last night. I'm going to zoom in here down to a monthly view here. This is the 60-minute chart of ES. You had those last night. We set up with some bear flag formations. Remember, we had that impulsive move down yesterday, put in the bearish engulfing candles, and sometimes we get those. Sometimes it looks like you start to flag, but you don't. Components of a bear flag are three things. One is the flagpole, an impulsive move down. Two is a period of consolidation. It typically occurs on lower volume. The move down you should see on high volume. You can put up volume bars, you'll see that. There it is, big volume on the move down right here, down below, decreasing volume, and then bigger volume. And yes, that does coincide with the overnight session open, but it is what it is. It's part of what how this stuff works. Whether or not that happened during hours or after hours, it's same. The most important is you do have the nice looking flag there, and we just broke down. The technical measurement for a bear flag pattern is the you take the distance of the flagpole, add it to the lowest part of the flag right there. I didn't have that drawn up perfect. It should have been like that. And then you take that flagpole and you add it there, and that'll give you a measured target. I just eyeballed it right there. And to turn back on my level, so here's what we need to watch today. We flagged that breakdown, the impulsive move after the open took us right down to my next support level there, 31.14, and you can see after that. So the way it works here, and it's not in a vacuum. You want to watch the other indexes. You want to watch NQ, the FANG stocks, and we're going to hit those today. That's what I'm going to go on, really the things that will determine where the market goes from here, and also bigger picture, daily charts, what to look for there. We did have the bearish engulfing candles yesterday. So far follow through today, but the day is very young. And if anybody's been around for any period of time over the last few months, if there's one thing they've been buying the dips here. So it's not over till the fat lady sings, or at least until the closing bell rings at 4 p.m. is what I like to say. So we'll see how the day ends, and so that's what I want to look for is, do we take out this level, 31.14? If so, that likely opens the door down to the next level. And if so, this stuff is kind of a, domino effect, if you will, or it's what I call the charts being stacked. You get this, move down on the 60-minute chart. Well, what it's going to do is firm up those sell signals we got on the daily chart yesterday. And if it doesn't, then those signals could be called into question. I'm going to get to those in just a second here. Let's look at NQ real quick. Okay, very similar price action. Yesterday, as I mentioned, in one fell swoop, they took out, we were here when I did earlier video, took out the trend line to trigger a near-term sell signal on the 60-minute chart, and set up a little flagging action right below there. Perfect. That's textbook. And so far, we reversed ES and NQ, both reversed just a little shy of that support right there. So I favor another thrust down today. In fact, I still favor more downside here is what I favor. But watch this. And I'll say this, and I said it a couple days ago, and I'll say it again today. I still think shorting in this area for swing shorts is objective with stops not far above because of the the resistance levels on the daily charts, everything I'm going to get to in a second. It's certainly not an all-in short moment. On the backdrop, you have just a resilient trend. You have a lot of Fed intervention into the market, liquidity injections, even outright stock manipulation by buying assets that should be going down, like low-grade bonds and even higher-grade investment bonds, distorting the whole price discovery mechanism. That is the natural interaction between buyers and sellers that determines what a security is worth. That is gone for I don't know, maybe the first time in history. There's been, in 2008, sure, there was a lot of intervention in the markets and all that. So I won't say it's the first time, but this is, I believe, the most excessive distortion of the natural price discovery mechanism in the markets that I think we've ever seen. And that, to me, that's dangerous. Maybe I'm a glass half empty guy, but I'm a firm believer. You can tweak the markets, but when you come in and you try to lift up the markets, which they have done, and boost confidence to bring stock prices, there's such an extreme disconnect from where the fundamentals actually are in the economy. I think the Fed's setting the stage for potential crash, big drop. But again, that's nothing new. Let's just get to the daily charts. Let's go to the charts of SPY. It's and I just want to loop back to this. I'm going to kind of be all over the place here, and let you know my mindset into what goes into my thinking here, and how you might want to approach this. You'll all have your own opinions, and other people have different opinions. Nothing's changed for me in a long, long time. This is the primary bull market trend line in the stock market, the S&P 500. Remember, the Nasdaq 100 is not the stock market. It's pretty much a reflection of what the 5 biggest stocks in the world are doing, the FANG stocks, for the most part. That's what's driven that up. But here's the stock market, and this is more, the economy pricing and what's going on. And I, like some others, believe this is really where the bull market ended. Not technically, because he went on to make a new high. That was back in 2018 on that big drop. But since then, we broke down and we back tested. So, going off a pure technical perspective, all this is a breakdown and back test. You might say, well, Randy, yeah, but that was the fourth quarter of 2018. Here we are in the middle of 2020, almost a year and a half later, over a year and a half. Well, thing is, and I always say this, everything in technical analysis, all these patterns, all these projected moves are commensurate with the scope of the pattern itself and the scope of the time frame you're on. You're looking at the longest bull market in history, a la the Fed and other central banks, one of the longest and strongest, or the longest. And a lot of that was, induced or exacerbated by easy money policies, and again, intervention of financial markets. So what they did is they created, enormous, what I call supersized bull market, and such. All these things are going to take longer to play out. Let me give you an example here, and then we'll get back to the charts. Just to let you know my mindset here. DraftKings is one I recently, I might have covered this in a video as a trade idea. I believe I did. And we had a breakdown here. And now this is a relatively new company. What I did is I flipped over to a daily chart. You can see this one started trading back here, didn't really move to right here. And you can see this pure, nice clean uptrend line, just like that bull market uptrend line on the SPY, but on a much smaller scale. This goes from April of this year, and now we're on a shorter time frame, much shorter trend line, and you get the same thing. Sometimes you break down and that's it, but in this case you broke down and you hit price support and you back tested, and you went on again, almost another near back test. So this whole thing right here on a much smaller time frame is what I'm seeing on the S&P 500, and believing that in DraftKings, I just picked this one because I was looking at the chart recently. There's many other stocks like this that I've traded over the years, and many I've highlighted that may have gone on at this point to backtest. If you extend that trend line a little higher, make a marginal new high, and then continue down. So again, that is what I see when I look at the SPY on a much longer time frame, on the weekly time frame. Again, just a breakdown of that blue trend line right there, the primary bull market trend line, divergence, negative divergence leading into that high right there, 21% drop, and we back tested, and then a bigger drop, and we're still below that high, and that was also a divergent high right here. And so that's the snare I lean towards, and it helps to shape my longer term outlook for the market, and it's relevant to today, because today all we have at this point in time are some, well, actually I was about to say short-term sell signals. When I was looking at the 60-minute charts, that's what they are. Now I'm gonna on the 60-minute chart here, but you can see this on the daily as well. We have what I believe to be an intermediate term or a little bit longer term sell signal, because we had a fake out. Well, I talked about it yesterday. I talked about it before it even happened. If you pop that level and move back down, then you have a failed breakout, aka bull trap, and those have usually lasting bearish implications. We'll see. Does the Fed come in and gun the market? Maybe just the buyers. Maybe it's natural buyers. The Fed's put so much money in the system. So I'm not going to blame the Fed every time the market goes up and doesn't go down the way the charts indicate. It is part of the equation, undoubtedly. But, the day I stop, looking at and using what's been working for many years, even if it doesn't work all the time, even if it works a lot less now than it used to because of the the injection liquidities and everything else that's going on in the markets. The day that I just start buying stocks because everyone else is buying, they call that the greater fool theory. You buy a security, a stock, only expecting that there's going to be a greater fool to buy it from you at a higher price. That's what's going on right now, by most accounts, most metrics, not just what I see, but from, what I hear and read as well. So that's it. So there is what I'm getting at is a more lasting, potentially more lasting sell signal, the bear trap. And on the 60-minute time frame, you have the breakdown of the rising wedge. Let me show you. I know there's a lot of lines here. And again, these are things I'm watching. If they're going to foil it, they have the potential to foil this soon because that's a pretty powerful sell signal right here. So everything that's happened in the last few days. So let me make it simple. If they can do this, turn around, take such a nice sell signal as this reversal, and just gun the market up. There's always this stuff isn't black and white. Net, that's going to be bullish. A move considerably above there, especially if they can take out these divergences. If they run back up to test that high, I can certainly say that's not going to help the bearish case. It's certainly going to chip away at it. It's going to help the bullish case. It won't eliminate. You're still going to have some negative divergences. But the ideal scenario, and that's why I'm doing this video, the ideal scenario would be to see the technicals start to work here. See this back test right now. Remember, I tweaked this trend line before. I had it right here before the breakdown, and then yesterday in the video, remember, I pulled it down to here. You can use either one, or I'll put both there, and I'll update this later. So these are the levels I'm watching today on SPY. I'm watching this trend line. Right now we're back testing the lower of the two as well as that 314 resistance. I want to see rejection. I don't want to see SPY recover these trend lines. I most certainly don't want to see it get back above there. If it does, well, it's going to do a lot of things. Let's flip out to the daily chart. It's going to foil those candles. Right now, it's not a bearish engulfing on the SPY, but it was on QQQ. So a move back up above yesterday's highs is going to take away what was a pretty powerful sell signal on the tech sector and QQQ and a lot of other stocks like the Adobe setup that I posted today, things like that. So that's number one. No good for the bears, good for the bulls to take that out. Number two, it'll take us back above this or 1 month, multi-week trading range right there. And again, not a good sign for the bears. Good sign for the bulls to see that happen. And that's it. So to keep it very simple, we need to see some follow through. Ideally a red close today. The SPY's already gone green right now, but and although that is the stock market, this is what I'm watching today. It's all about tech. I've always said that from day one. The market will not break until tech breaks. It will not break until the fangs break down. We've got to start here. We have some early potential sell signals. And need a little more work. So it kind of goes back to what I said. I think it warrants a partial start or short position, and I'll try to get more individual trade ideas out to you, but I can tell you I think there's so much hot air right now in the FANG stocks and in tech that my preference, keep it simple. Keep it simple. Use QQQ, NQ, the NASDAQ 100 futures. That would be my preference of the indexes. If this market's going to roll over, I think tech will lead the way down. I think the Qs will lead the way down. So with one security, if you're prone to short, that is, you can short 100 different companies. You don't have to worry about earnings as much. Remember, we're heading into earnings season. That may be, it's probably going to make or break this rally. I can tell you that, most likely. It could just, continue the rally or put us in a sideways trading range. I can tell you to expect volatility. But the nice thing about going with an ETF, again, if one of your company, if you short Tesla or Apple and they gap against your position, or you go long for that matter, and it gaps against you 10% or more, and I've seen those stocks do that easily, time and time again, you're very, very unlikely you're going to see a 10% gap. You're not going to see a 10% gap up against your position because the futures will hit lock limit down overnight at 5%. So you're much more. You're safer, if you will, in especially when swing trading, holding position overnight in an index ETF or even futures contract. All right, so here's what I'm looking for today. There's those bearish engulfing candles. QQQ is still above trend. So like I said, Hard to get too excited about this yet if you've been waiting to short the next pullback. And if you're a bull, you might want to take note of this. That could be an inflection point and end to the rally. What I want to see is, how do we close today? I'd like to see a red candle today. All the better if we get a red one tomorrow. If we turn green today, what I don't want to see is a move up anywhere near the top, let's say the top 2/3 or higher above that candle, because again, it's just going to wipe out what could be, and so far as a sell signal. The bearish engulfing candle in itself is a sell signal, but again, I like to use confirmation, because sometimes you get those bearish engulfings on the way up in a rally, and then you don't get any follow through, and it doesn't mark a top. So that's what I'm looking for today, and if we get it, maybe add a little more short exposure by the close if it looks like we're going to get a nice red close, and again tomorrow, and then I'll be looking to see if this uptrend line breaks on QQQ, and then the same level I've been highlighting for weeks now, that's been defended, 242 I think is a big level on QQQ, and with this uptrend line just below it right there. So boom, boom. That's what I want to see. Bulls, you want a place to buy? Well, here's a trend line. Objective long entry to go, objective level to go long. If that breaks, 242 is support, and then below that you can see some additional support levels. But if we start cracking this, remember, there's a lot of hot air in this market, and the longer term charts, to me, are still indicating another big leg down, whether it's going to start, whether it started yesterday or it starts 3 months from now. I think that's still most likely priced into the charts. And on the QQQ weekly chart, I mean, the week is still young. We've got, today's only Tuesday, right? So we have a few more trading days left in the week. We'll be watching that. The lower we go, if we go much lower, especially heading into Friday, but let's just say tomorrow we're down here, Thursday we're down here, somewhere in there. Little chance, it's still possible to get a recovery, but it increases the odds. The bigger this red candle, this is our weekly candle. Remember, this is a dynamic candle. These are static, they're fixed, they're past. This one will go up and down throughout the week, and all that matters is how it closes the week. So the farther we get away from that one, if that happens, we're going to have then a bearish engulfing on the weekly, and those are pretty solid. I'll just kind of eyeball here going back, and you can do this on this chart or any other one. We had might have been, you just have to engulf the body of the previous candle. No, this green body was a little bit higher, I can see that, than that one. So going back, that was a bearish engulfing. Engulfed the previous candle, and from the high of that bearish engulfing to the drop, that was about a 23% drop. You don't get them often, and you want to look for them again after an extended uptrend. That's most certainly what this was leading up to that one right there, and that certainly fits the bill here. So again, something I'm looking for. I may be doing this video Thursday or Friday, and we're way up here. And if that happens, then I'll just have to say that's nothing but bullish. If they can recover and undo this sell signal, doesn't mean that I'm going to jump into the market long. It just still doesn't fit my comfort level. I'll continue to fry fish elsewhere, where I think the fishing is a lot better. Whether it's what some people consider boring old agricultural commodities, precious metals, wherever the opportunities are. But again, that's what I'm watching for on throughout the week, really, on QQQ. And what I'm watching for today, there's that uptrend line on the Qs right there, divergent high. There was our sell signal, our breakdown yesterday, coincided with that breakdown in the futures, and we've hit my first support zone. So here we are at support. This is where the buyers should step in. I went over this yesterday. We have these series of corrections. They come in fairly predictable or regular intervals, I should say, and they're all marked with the same conditions: overbought, negative divergence, and those corrections, as I said, range from about 4 to 7%. So far we have one that ranges from top to bottom about 6, so we're right there. So I'll say this, those that are bullish and believe the Fed is all powerful and going to keep this market up as long as they want, there's your objective entry. If we come down here, there's your objective entry. If we come down here, there's your objective entry. I'm not interested in that. I think, again, a lot of hot air just because they've been buying the dips. That's not going to continue forever. I've seen a market that's completely disconnected, and I'm more eager to sit back and and look to add to shorts if these levels break. Just kind of again wait and see what happens the next few days. Some mild short exposure and something I'll add to if and when we see some of those developments I talked about. In other words, if the buyers fail to step in at where they should buy, where they normally buy, buying the dips, 6% drop, again, that's in line with all of these. They should, if everything continues as is, then this is where they're going to step in. If we drop a little more than that, then hey, something's changing. And remember, this is a 60-minute chart. If we get down here, remember what these candles are going to look like on the daily and even the weekly chart. So that's why I'm jumping around all these time frames. And finally, last but not least, let's just look at tech and the fangs. XLK, there it is. So we had a beautiful bearish engulfing candle in the tech sector that wiped out not just one candle, but multiple candles. So in one fell swoop here, yesterday's candle wiped out 1, 2, 3, 4, 5. A week of trading, 5 previous candlesticks. And that's certainly a bearish technical event. Today, so far, another check mark for the bears. We broke down below the trend line. That's the same trend line I've had here for a while, right there. Purple trend line's, what I'd call not a super significant trend line, but it's certainly one worth noting. It comes off about the mid-April lows right there, that candle. In fact, I could extend it all the way over to this candle, that gap right there. So that would take us back to early April. I could, if I need to, and we'll see what happens, pull that line down like this. There's less reactions there. I only have that one, this one, the bottom of that candle, and this one. This is where I had the line. I think that's the better fit. Why? Because it captures more candlestick bodies and or shadows, the skinny parts. So there's the trend line, and so there's a breakdown. So again, ideally we close below. We do not recover this line today, ideally for the bearish scenario. And then the next thing up, if we do move lower from here, 101.79, big level that I've been watching and highlighting on tech for a while. XLK danced along it for a couple weeks here and held that support level. So a drop through there would be bearish and likely open the door to more downside. And why do I lean towards that scenario instead of the dip buyers coming in here or here? Well, it's this and other things. On the daily and weekly time frames, negative divergence, same divergence we had here. I know nobody at this point, everyone thinks the market will go up forever, and who knows, maybe it goes up longer, but that's what everybody was thinking here, and it took a divergent high that finally played out for a nice drop there. Was that drop fueled and aided by COVID? Yeah, COVID was the catalyst, to just spark or trigger or play out the correction that was already priced into the charts. And I don't know what it'll be, but if we do drop from here another, let's say it's a trend reversal. Let's say we're going down another 20% or more, at least from where we are. Trust me, the headlines will follow. I don't know what they'll be today, whether it'll have something to do with COVID, whether it'll have something to do with China, the economy, earnings, any or all of the above. The news will match the move down if we get that. So all we can do, we can't predict what the news will be. The best we can do, at least I can do, is look at the charts and say, okay, well, this is an objective short entry. It's a breakdown. We're still above support. We're just off the highs. So again, that's why you can't get too excited yet, but you can take a position. And again, it's about risk reward. So maybe it is another boom, false signal. So where are we on XLK? Well, we're only right now from yesterday's high, we're only 4.5% below it. So if this is a major inflection point, turning point in the market, and you short it right now with a 5% stop, and you're targeting 20% or more downside, well, that's a 4-to-1 risk-reward ratio right there. I'll take that all day long. That's a phenomenal risk-reward ratio. And now we're going to look at this. Again, tech needs a break. That is a sell signal, and there's a sell signal. Bearish engulfing, follow-up red candle, trend line break. So we have a few check marks. This is what I've been waiting for. 101.79 goes with conviction. That'll be even better. And we're going to look at these. Remember, tech is about over a quarter, by far the largest sector in the S&P 500. It's about half of the NASDAQ 100. And you can see these guys alone, two stocks, Apple and Microsoft, make up nearly half of the XLK, the tech sector right there. Before I get to the fangs, let me just show you this. This is the weekly chart of XLK. What stands out here? A few things. We already have, and again, the week is far from over. I can't say that enough, but at this point in time, we already have a bearish engulfing forming. So it depends on how we finish the week. That is a nice, clean bearish engulfing, completely engulfed the previous candle in XLK. Haven't seen anything like that in a long time. And we also have clean and clear negative divergence. Not yet confirmed. We want to see this PPO roll over right here. That means this blue line turns down and crosses the white line, the signal line, and effectively then puts in a lower high right here. Lower below this previous high. But that is negative divergence. And so here's a chart that when I look at this chart, it indicates another big leg down coming. Where to? Well, here's our bull market uptrend line for tech. Well, at least one trend line that I have. This one comes all the way back from the 2009 lows, and that's a potential target, as is this 82.84 level. Okay, and to wrap the video up, let's look at the fangs real quick. Here's Apple. So here's Apple. On one hand, we have the bearish, not a bearish engulfing candle, just a big red candle yesterday, but Apple's still above trend. So try as I may, I'm not going to try to extract anything out of this chart that's too bearish. We get red candles along the way, and the uptrend continues. So still pending a breakdown on Apple. It's a pretty clean trend line there, and I want to see Apple make a solid break, even better, a solid red close below that trend line. Otherwise, it's still above trend. Now, there's negative divergence. Clean divergence down here. You can see I have a lot of annotations here, but there's your divergence on the RSI. I have to stretch this out. You can see it there on the PPO. PPO is so wide right now, it's hard. That's why I had to stretch this out so you can see the divergences, but they are clearly there. Again, another way to do it is just roll past that point in time right there. There you go. Now you can see the divergences a little better. So negative divergence, just like you had here heading into that high. You have earnings coming up on Apple, and you can see that's been not always. Sometimes it just continues the trend. This came after a big correction, but earnings back there on January 28th was pretty much around the top. Apple just stalled out from that point, traded sideways for a few weeks, extended the divergent high that they had there up to that point, and then boom, bottom fell out. So that's what we need to see in Apple. We need to see this trend line break. Microsoft still above trend as well. I've got a couple trend lines here. This one I can extend out. But again, so right now on these market leading stocks, only a pullback. I don't see any solid sell signals. I'm sure if I went down to the 60-minute charts, I might be able to pick up some trend line breaks. But work to be done is what I'm trying to say. The market leaders haven't broken down yet. They've just pulled back. And that's why I don't think it's an all-in short moment. That coupled with the resiliency of the trend. That resiliency of the trend hasn't always stopped me. It certainly will temper, how aggressive or I might short. And here's Amazon. Amazon's a big old fat bearish engulfing. Wiped out the previous two candles, trading red today again. Also put in a divergent high at that high yesterday. So there's one that we do have a sell signal. Still above trend. Again, you go to 60-minute chart, you'll see this little minor trend line I just added there, and we're down below that. And that trend line would show better on a 60-minute chart. So we'll watch Amazon. If it can, obviously for the bearish case, you want to see more follow through to the downside to kind of solidify and leave that bearish engulfing candle all alone up there by itself. That's what we want to see for the bearish case. Alphabet, big bearish engulfing candle after divergent high, just to pull the lines. Just like football, you get a first down, they're going to move the markers up on, that's what we do here with these divergences unless they're taken out. So we've had divergence building, and yesterday put in those. Yeah, look, close enough. Yeah, it matched the body of that previous candle. We'll call it a bearish engulfing. And there's two share classes. We'll look at the other one. That one doesn't have it. GOGL did. Let's see. Facebook, bearish engulfing candle, divergent high. Facebook engulfed 1, 2, 3. At least the previous two candles there. It's a lot of support here. You can see 232.44. Need to take that out, and then I have yellow. That's the big level. That's why it's color-coded yellow. 222.78 or so. Why is that? Well, I think that was a big level for Facebook. We had a previous high back here in January before the bottom fell out. We broke out there as your breakout candle. We back tested that for weeks there. Numerous back tests. We had one little whipsaw. And that's what this market's doing. That looked like a legitimate breakdown. I remember highlighting at the time. It was a solid breakdown, but I also said it was only one of the 5 fangs. You need to see the majority go. That means at least 3 of the 5 go, and it didn't. And because of that, the rest kept going up. Facebook sucked right back up above that 222.78 level. Only spent a day down below there, and got it back. So I'm still watching that again. That's the to me a pretty big level. And let's see if there's anything else I want to cover. Let me just extend these divergence lines before I do that. No, that's it. I'm just, like I said, starting to nibble at some trade ideas here. Like I said, the success or failure of these will largely, but not exclusively, depend on whether we get breakdowns, everything I just mentioned in those FANG stocks, and follow through in the tech sector. This is Adobe. Nice, clean. I mean, I love the chart. And again, if the market can break down, then I'll most likely add additional targets to it. You had a big bearish engulfing yesterday that wiped out, over a week of trading, and solid breakdown today. Very clean uptrend line, well-defined channel, divergent high. And I posted an update under this in the comments section. Not only was this previous divergent high back here, it was also a bearish engulfing candle as well, and that was a catalyst for the drop of well, I'm going to move that trend line. I'm going to have to grab a little under it and go down a little below. About a 35% drop in Adobe. A nearly virtual identical technical posture. It had a price channel there as well. You can see the divergence was up at the end there, and again, maybe this doesn't pan out, but if I don't take these, over time, you take these enough, and you're going to get in early. And the risk reward is what I like about a lot of these. Minimal downside if stopped out compared to the profit potential. And again, I'm only listing 2 targets here. If the market gives us a whipsaw, I'm not going to, obviously I won't extend targets, and we'll probably get stopped out. That's just how it goes. Maybe we go on and back test. But sometimes, especially when a market tops, you can start to see, and we have seen, I've talked about this, deterioration in the market internals. In other words, fewer and fewer stocks, namely the big fangs, the crowd favorites. Tesla's not a fang, but it's certainly a crowd favorite. Netflix, you see those and the fangs lifting the market, while more and more within the NASDAQ composite and even within the NASDAQ 100. The NASDAQ 100 is 100 largest in the NASDAQ. You start to see those break down. So this one could break down exclusively, or start to move lower from here, or continue to move lower even without the market, even if the market doesn't roll over for another 2 months, let's say, or a month. And then the other one, what was it yesterday? I posted PayPal. That was first posted as a setup the other day, last week. I wanted to give it a little bit of a margin of error. We got technically broke my trend line on Friday, but I wanted to wait to see that 176.50 level go. It was minor resistance. We got that yesterday, and so nice big impulsive candle following the breakdown there. That's what you want to see, and follow through today. So these are some of the my top picks, obviously, if I put them on as official trade ideas. And depending on what happens over the next day or two here in the markets, in other words, whether we follow through on those sell signals with more downside or not, maybe we trade sideways for a day or two, because like I said, the Nasdaq's dropped 6% in the last less than 2 trading sessions, so it might need a breather in the near term. So maybe we'll just kind of wait and see what happens if we trade sideways for a day or two. Now, if we head up sharply, then like I said, there's a potential to undo a lot of these sell signals, but that's not my preferred scenario right now. I'll just have to react to it if and when it happens. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.